We'll go ahead and get started. Thanks everybody for jumping on and appreciate folks changing their schedule to meet on Thursday instead of Tuesday. That worked out well for those of us here in the office. We had a funeral that we attended on Tuesday. I'm really excited to be able to kick off the third training that we've had for Water Resource District secretaries and other staff. For this third training, we have a team from Bell Bank in Fargo talking with us about some financial resources for water resource districts. So I'm going to turn it over to Rebecca, who's going to kick us off for the presentation. And just a reminder that this is recorded and it'll be on our website. So if you have other questions or you missed something, you can always go back and listen. And if you do have questions, feel free to put those in the chat or raise your hand and we'll get those answered. So with that, I'll turn it over to Rebecca.
Okay, thank you so much. Yeah, this will be, we have a lot of information that Nathan and I are going to cover today. I'm going to share my screen. We'll kind of get that kicked off. But I do also want to remind you that we'll make this presentation available for emailing out afterwards as well. So as I said, there's a lot of information on here, but we don't want you necessarily having to scribble notes during the whole time. We want you to be able to focus on us as we're presenting. So just take some short notes if you have any questions, because we'll have time for questions at the end. But don't worry about trying to gather all the information on the slides, because we'll make sure they're available for you to access after this presentation. All right. Okay. Julie, you guys seeing the full slides there?
Yep.
Perfect. Okay. As Danielle mentioned, Nathan Erickson and I are from Bell Bank. I work in our treasury management department at Bell Bank. Nathan works in our institutional investment division. And we are a bank we're North Dakota Bank, headquartered in Fargo. We're really excited to be presented or given this opportunity to share some of our experience and our knowledge with you and hope that we can become a resource for our water resource districts. We'll talk today about a lot of different information. We're going to talk about the types of financial losses that can occur, as well as some things that you can do to reduce those risks. How you can pull your bank in to help with that. And then we're also, at the end, we'll talk about different financial information. So Nathan's going to present and share some information on just the economic environment as a whole, interest rates, and how you can pull those into your day-to-day banking and investment practices. So just starting out here, we'll talk about just the prevalence of payment fraud. This is a slide from the American Financial Payments Association and their publication that they put out each year, where they just gather information on the types of payment fraud. And the main takeaway on this slide that I want you to look at is this, that regardless of the size of organization, whether it's under $1 billion or over $1 billion in revenue, the overall percentage of organizations experiencing attempted or actual payments fraud is 80%. And that's why it's really important to think about this as not a perspective of, will it happen to me? Yes. You have to kind of go forward with a thought that your organization will get targeted at some point. Doesn't mean that it'll be successful, but you do have to keep that in mind as you're setting your internal practices, that it's a very high likelihood there will be some attempts to commit fraud on your resource district. This talks about the different types of fraud that are commonly used. The most, obviously you can see at the very top, the most common type of fraud is an outside individual committing some type of fraud using checks, whether they are washing a check that you've actually written and changing the payee, or whether they are forging or creating counterfeit checks, 65% of fraud on an organization is performed by an outside individual using checks. But these next couple options or line items here are really significant as well. So business email compromise, 38% of the type of fraud that's attempted comes through emails. And so that's a significant area where we all know we have to be very vigilant when we're reading and receiving and what we're opening from our inbox. A vendor imposter, that's another huge area and pretty frequently a successful way that fraud is performed. And then U.S. Postal Service office interference. And that's typically if you're mailing checks out, at some point it's going from your office to the Postal Service and then to the receiver of that check. That fraud is, that's where U.S. Postal Service interference comes in, is if somebody pulls that envelope or that check out of the mail. And then this is the payment methods that are frequently used or subject to attempted or actual payments fraud. Big thing here is that obviously down at the bottom, we see the trend from 63% of fraud was committed by check in 2022. It actually went up in 2023 from up to 65%. So still checks are the most vulnerable area payment for payment fraud. But we also look here at our ACH debits, about 30%, and ACH credits. Most recently, 19% of fraud was committed this way. And what that means is you're starting to see a lot of fraudsters move from the paper realm of checks into electronic methods. So they're trying to either get you to pay them electronically, or they're pulling money electronically from your account. This shows the percentage of lost funds that are recovered. So 41% of the organizations that actually did have fraud were able to recover about 75% of their loss. But then you look at over here, the next biggest chunk of this pie chart is 30% of the organizations recovered nothing. So they weren't able to get anything back. And then you look at the other categories, about 50% of these organizations or of organizations recover less than 50% of the funds that are stolen from fraud. So this really gets to the heart of the matter that it's better to prevent and put some steps in place to try to prevent or capture fraud from occurring rather than try to recapture the funds once they have left your bank account. Now I'm going to talk about some different types of, I'll get back onto this, sorry. The types of attempted and actual payments fraud. Of those organizations that experienced attempts, 41% again had no loss, but 25% lost up to $25,000, and the next 25% are here. They're somewhere between losing $25,000 to $250,000. It's a significant chunk of funds, and as we remember from the slide prior, most of this money does not get recovered. So it's, again, just getting back to the point, we need to think about this in advance and think about some of the things we can do to prevent these types of losses. So I'm going to talk about some common ways that payments fraud occurs, some ways that they try to infiltrate your organization, and I'll share some stories if I have any anecdotes that I've experienced with clients that I've worked with. So I'll share that. And we do have on the slide some things, common things to do to just like immediately, if you experience this, what is a great way to react to that? So the first thing we're talking about is business email compromise. And this is a scam where the attacker pretends to be somebody typically from the organization, but it might also pretend to be a customer or a vendor. And they're tricking you into sharing information. So it might be sharing bank account information, it might be sharing money by sending an invoice, or it might be downloading malicious software. If you think that you've had any actual experience of this, you obviously want to talk with your IT team really quickly and bring in your bank. But the other thing that I will say is one way to mitigate any actual effects of this is if you have a vendor that you are typically paying by check, or maybe you are paying by a wire transfer, and you get an email that says, hey, we've changed banks, or on their invoice, they say, we've changed banks and we want you to pay us at our new bank, then you should really go and confirm those payment instructions by using a secondary method. So that's typically by picking up the phone and calling them, calling a known contact at that organization. This is a really valuable way that um, scammers like to use this email compromise, because it doesn't really take a lot of effort on their part, but they can really get some big payouts from it. So an example that I know, I had an organization that was doing a construction project and was wiring funds to a lot of the contractors they were working with. And they received an email from a contractor saying, hey, we've changed our bank account. Send our next invoice payment to this new bank account. My client did that, updated and sent the payment out, but they hadn't verified it by using a phone call or another method of verification. And they actually ended up paying about 2 invoices to the fraudster before the legitimate contractor reached out and asked them why the payments were late. So my client had spent about, I think it was about $80,000 that they had sent out to the fraudster over the period of a couple weeks before it was discovered. And there wasn't a way to recover those funds. So it needed to end up being an insurance claim or a loss to that organization. So it's just a simple thing you can do is to just verify those payment instructions when they come in. Ransomware is if a computer is infected through malicious software, and then it takes over your network. And usually what they're going to do is either they're going to hijack your data and threaten to publish it out in the world, or they might just block you from having access to your data. And they say, we will release this if you pay us a ransom. Typically, they're gaining access into your network. It could be from an unsecured network, but it might also be just from clicking a link in an email or downloading some software. So it's really important to have good hardened network security to prevent this. And obviously, make sure you're checking when you are opening attachments that come to you through email. Make sure you know that where they're coming from, make sure they're expected. And with ransomware, I will say this happens. I actually heard of a small county that is a Minnesota county, but they did have a ransomware incident about 2 years ago, and it was quite an expensive thing to unwind. They had to get in there, obviously get their insurance company involved, a lot of IT involved, and I don't know. I think typically when these situations come up, your insurance company handles whether you will or will not be paying any kind of ransom. And I never heard the outcome of that, but it did lock the county up from being able to actually do any business for about 3 to 4 weeks. They weren't able to access their network. So it's pretty detrimental if this comes into play. Check fraud. This is, again, we've kind of learned earlier, this is often performed by outside parties, most often. And it could be if a check fraudster snags one of your legitimate checks and washes the payee to put their name on it instead of your vendor or your employee. It could be that they're creating a counterfeit check or forging signatures on that. And if you do experience a check fraud, if you discover this, it's important to contact your bank right away. With all business organizations, you really only have about 1 business day in order to report that to your bank to ensure you can recover those funds. So if you notice a counterfeit check clearing your bank account or posted to your bank account on Monday, that means you need to report it by the end of day Tuesday so your bank can initiate the dispute process and recover your funds. Outside of that window, if you report to it on a Wednesday, obviously your bank is still going to dispute and they're going to try to get the funds back, but there's no regulation protecting you. So if the funds have walked away, if the fraudster was successful in pulling that cash out of the bank and walking away with it, there's no protection for you as an organization to get that back. So it's important to be looking at your accounts frequently, watching transactions, and then if you see anything suspicious, reach out to your bank right away. Another type of fraud here is ACH fraud, and this would be if somebody is maybe a fraudster is using your bank account routing number and account number, which they can receive, they can get off of your checks, and are committing ACH debit fraud. So that might look like, this is an example that I have, where we don't know how this information got out exactly, but an individual had gotten a business account number, routing an account number, and they plugged it into their apartment portal. So they were renting an apartment, they could go into this online portal and just plug in a bank account in order to pay their rent. This individual was able to successfully pay their rent using a company's bank account for about 3 or 4 months before the company discovered it. Again, this is one of those things. It's so far past the 24-hour turnaround of when you can report it that a lot of those funds were not able to be recovered and received back so a lot of those were just losses to the business. Wire fraud, well, this often happens where fraudsters are hacking in and forging invoices or intercepting invoices and altering that wiring instructions to get a wire transfer. It could also occur if somebody is posing as a fraudster is posing as a commissioner or a manager, water resource manager, and they want you to go to the bank and do a wire transfer. It's important when you do receive, as I mentioned earlier, if you receive any invoices that change payment instructions, it's important to call that vendor and confirm. And then if you do receive any kind of urgent email from somebody in your resource district, or if you get a text message even that's saying, hey, I need you to wire out this money really quick, it's really important to pick up the phone and call that individual to make sure they legitimately sent that and ensure that it wasn't a fraudster posing as that individual. Occupational fraud, this is going to be internal fraud. So this relates to individuals who work in your organization, either getting bribery, kickbacks, stealing cash, falsifying their wages. There is a fair amount of that. I know that goes on, and what's often really disturbing about this is the length of how long your internal employees can continue doing this without it being discovered. So the median duration of internal fraud like this is about 12 months. So that means on most instances of this last 12 months. Local government's loss is typically around 125,000. And I know there was a water resource district up in Minnesota that experienced something like this, where the employee was actually just creating additional paychecks for themselves and they were getting signed off, but it was just, I believe that individual was maybe getting a paycheck signed by one commissioner and then creating another paycheck and getting it signed by a different commissioner. I think that is kind of the instance. It's just important for everybody to recognize that you have a small team, and everybody plays a role in preventing fraud. So whether it's performed by an outside party or an inside party, everybody, your commissioners and everybody on your staff has a role in preventing this. So we'll talk about I've scared you, hopefully scared you. I want to talk about some of the best practices that we can do to reduce your risk and maybe just mitigate any potential for losses. So the big thing, and I've talked about this a couple different times, is when you do receive payment instructions from any vendor, you should have a policy of verifying those payment instructions. Just like if it's the very first time your vendor reaches out and says, hey, we want you to pay us, can you pay us by ACH or online wire transfers or to this bank account? It's important to pick up the phone, confirm those payment instructions. And anytime that those instructions change, you want to do the same thing. So it's really helpful if you have enough staff on hand to be able to add some dual control in there, which means like if one person on your team was taking these payment instructions and preparing the payment, so whether, let's say it's a wire transfer, they were preparing the details to be wired out, the second person on your team should go and ask person one, did you confirm and how did you confirm these payment instructions? And then individual number two should review that payment before it goes out, just to make sure that your policy of verifying payment instructions was followed. And it's also not a bad idea to start looking at the contracts that you put in place with your vendors and think about defining how those payment instructions need to come. That way it's just laid out there. And so vendors can't be reaching out kind of willy-nilly, sending you emails, sending you faxes, that they have a protocol that they need to follow in order to change their payment instructions. And obviously vet all of your vendors and your suppliers and perform a risk assessment on any of those vendors that might have access to critical information. So you want to have a risk assessment for any vendors that have access to your internal networks and different specific instructions with your company. So email and IT security. This is again because there's a number of different frauds that does come through and can come through your network and through email. And we've heard it over and over through the last 20 years. Our IT teams are always telling us that we as individuals are the best preventer of fraud. And that's true because we are receiving so many emails throughout the day. And it's really important for us to pause, make sure that email sounds legit and is expected before we open any attachment or click any link. As we know, I don't know if you do have an internal IT team that can do some testing. It's really nice to be able to have them send test phishing emails to employees. And that would be like they pretend to be a scammer trying to get an employee to click a link. And if you do, as an employee, click a link, you'll get kind of a little naughty-gram from your IT team saying, hey, we were pretending to be a scammer. That is really nice to employ if you have the capability to do that. If you don't, it's definitely important to do some type of IT training with all of your staff and your commissioners at least annually. And you could do that internally, but there's a lot of outside resources that can help. And I believe the state of North Dakota has some, or maybe Danielle can share, I believe there is some resources on some training that is out there and available. Obviously, be wary of any email that demands urgency or pressures you to make a payment on something really quickly. Typically, we see these fraudsters employing social engineering tactics that try to throw you off your game. So they try to frazzle you, and they might be emailing you and pretending or posing as one of your commissioners, asking you to send a wire transfer really quickly for an emergency reason. That's typically, that should put up your red flags, because we all know that emergencies happen in our regular course of business, but we also know that we can work through everything, and none of your commissioners should be coming at you and pushing you. That's typically a scammer or a fraudster behavior. Obviously, you should be using reputable antivirus and anti-malware solutions. If you don't have that on your internal network, that's important to get. Make sure you're updating your computer and your softwares on a regular basis. And whenever you can, if you are going to be accessing, especially if you're accessing your work network or your work computers outside of your office, you should be utilizing a VPN. So that's a virtual private network. And that creates, if you're going to be logging in remotely, that VPN creates a secure channel from whatever computer you are using into your network. And that is something your IT, whoever you utilize for IT, they can help you set something up for that. But it's very, very important to keep your information in your network safe and secure. Also, add multi-factor authentication whenever that's possible. So that would be multi-factor authentication looks like getting a text with a numerical code. It might look like having a third app or a second app that you go and you get a secure code that you need to plug in before you can log into your VPN. When we are accessing our devices, we want to use a password. We want to use Touch ID or Face ID on any of our mobile devices. Now, especially if you are utilizing your personal or a business mobile device and you're accessing your work network, this is important. And I know a lot of us, we have our banking apps on our phones or maybe on our iPads, and that could be true for you personally or with your work with the Water Resource District. And so you want to make sure that you are using a good password on your mobile device. There's a lot of people who don't have passwords still, and it's really important to do that. When you can, use Touch ID, Face ID. Those things are secure and a very safe way to access a mobile device. If you ever do receive a call or a text that's asking for your password or a multi-factor authentication code, and it's asking you to like reply within the text or to give that code to a person on the phone, you should not do that. You should stop. This is a known way that fraudsters try to gain access into your bank accounts or credit card accounts, anything, or even your email accounts. So anything that's using a multi-factor authentication code, just remember that those are created digitally, and the way that they're authenticated is also digitally. So you should never be giving that code directly to an individual, because we know that that's an indication of a fraudster trying to attempt to reset your password or gain access to one of your accounts. Use a password manager. We want to keep your passwords secure. So you want individual passwords, not the same password over and over on all of your accounts, and make sure that where you are logging these passwords is in something secure. So I moved all of my personal passwords into a password manager last year, and it was quite an undertaking. But now that I have them in there, it's very, very easy to just, whenever I'm logging into a new app, I just go to the password manager, pull my password over, and log in. So it's very simple. I encourage you to use that personally, and I encourage you to employ something like that at work too. We also have a password manager that I utilize at work, and I want to say I have about 50 passwords in there, and I'm sure you guys have as many or more passwords as well. Whenever a service gives you an option to set up multi-factor authentication, you should use that. So again, that looks like receiving a text or an email with a secure like 5 or 6 digit code, or it could look like using a third-party authentication app, such as Microsoft Authenticator. We at Bell Bank, we use the Symantec VIP Access app for this. Also, take a look at your internal controls. You want to review what kind of online banking access each employee has. So you should, within your online banking access for your organization, you should be able to see who all the users are. And consider setting some user limits for if you do have wire transfers or ACH payments linked with your online banking. You can limit that to a certain dollar amount. You can also request that dual control be set up to allow or require 2 people to be involved before any payments go out. And make sure that you're really only granting access to employees that they need. So, you might want every commissioner to be able to go in and look at your account balances, but not every commissioner should have full access to transfer money between maybe the checking and the savings account. So, you can tailor that access and you should employ that. Look at some of your high-risk processes and who all is involved with that. If you have, we all have small teams, and I very much understand that. Sometimes you can just utilize something as simple as a job rotation. So if you can have one person entering invoices this week or this month, and then you flip-flop, and next month a different person is entering all of those invoices, and you kind of go between them. That's a good practice to just help prevent any type of internal fraud. You should reconcile your bank accounts daily or use a service like Positive Pay, which we'll talk about. Again, reconciling those banks daily is going to get down to, if you remember, if you have any type of check fraud or ACH fraud, you need to report that to the bank within, hopefully within 1 business day. That gives you the best chances of being able to recover funds. And just internally adopt a code of conduct and an anti-fraud policy so your employees know where they stand. Also, how they go about reporting if there's any suspected fraud. And engage a third party for a review or an audit. There's resources out there that I know the state provides that can help you with this. And lastly, make sure that you have cyber insurance. That should be included in your insurance coverage. Make sure that that's a point of discussion when you are going through and reviewing that. That type of cyber coverage, there's a lot of nuance to it. I'm not an insurance agent, so I'm not going to pretend to know all the details. But if there's any type of ransomware, if there is any kind of fraud that maybe some fraudsters were able to infiltrate your online banking and initiate payments, some of those things, that's covered under cyber insurance. So you should be having conversations with your agents about that. And then let's talk about some of the specific services that banks have that can help you. The first one we'll talk about is Positive Pay. It's definitely the thing that has the most impact out there. It protects your bank accounts and your money. and notifies you of any potential fraudulent activity by blocking fraudulent checks or altered fictitious checks or counterfeit checks. And it also blocks any fraudulent electronic debits. It allows legitimate companies to collect their payments and prevents illegitimate fraudsters from collecting payments. So this is definitely the most valuable service that I would recommend, and I would love to see every business and organization that I work with utilizing this service. If you aren't using it, that's something your banker should have presented to you, and you should talk about with them. You dig into your online banking that you have and look what is available there. A big thing is going into the online banking alerts and looking to see which ones are turned on and which ones should be turned on. Make sure you're looking at your login settings and your password reset options. So you can set alerts to, send alert whenever somebody attempts to log into your online banking. And that's kind of a really valuable one. And you can create some reports. Usually within online banking, you can create reports showing daily transactions so you can reconcile more easily. And you can also create user access reports to show you what your online users have access to. And then I am going to actually we're going to pivot here now, and we'll let Nathan Erickson talk a little bit more about the market. And so I'll kind of let him take over for a bit. And then we will leave time again at the end. So if there's anything I've already covered that you want to ask questions on, we'll leave time at the end for that. Okay. All right.
All right, thank you, Rebecca. I'm going to share my screen here so I can use my pointer. One moment. Okay, so I'm assuming you can see it now. Maybe a thumbs up, Rebecca?
Yeah.
Okay, great. Happy to give a quick market review, what we're seeing in the economic environment and how it relates to you, and particularly how it's going to relate to you is probably more on the interest rate side, for short-term reserves and then laddering out, fixed income as well. But really quickly here, just the broad economic environment. It's actually been a really good year to be an investor, and it has been for the last few years. Really, no matter what you were invested in, personally, probably more on the equity or stock side in your 401ks or your 457s or 403bs, your retirement plans. Personally, stocks here have done really well year to date over the last 1 and 3 years as well. Really, no matter what you were invested in, it's gone really well. We've had some volatility earlier here in 2025. We had some big market drawdowns in like March and April, but those are forgotten now. It's actually been a really good year all around when it comes to equities. What's probably more relevant to you and your water districts would be fixed income returns. Depending on if you're in shorter term reserves like money markets, we've had a really good few years as well, hovering between 3 and 5% returns when it comes to more of those cash short-term equivalents. If you've laddered out at all into longer term fixed income investments, we've had higher returns here, hovering between 5 and 6% over the last 3 years. So overall, we've had a really good environment the last 3 years particularly. But what we want to talk about is what do we see going forward from here? Unfortunately, the government shutdown did throw a wrench into a lot of the economic data at a time when there was already a lot of uncertainty around what the Federal Reserve is going to do going forward. The fact that we had that prolonged government shutdown means we don't have all the inflation data or employment data. They weren't able to collect that, and they're probably not going to have a lot of it before their next meeting, which is December 9th. We did have some employment data come out this morning, but it's from September, and it's only pieces, really. So that's throwing some more uncertainty into what we see, going forward here in the near term. When we talk about the overall yield curve, or the interest rate curve. Some perspective here is, 5 years ago, we had very low interest rates. And this chart here from left to right, the very far left would basically be cash or overnight rate. And then this one is a 1 year, 3 year, 5 year, 10-year rate, 20-year and 30-year. So we're going from short-term rates on the left all the way to 30-year interest rates on the right. And what's normal is for this to have an upward slope. In most environments, short-term rates are lower than long-term rates. It's supposed to be upward sloping. Now, 5 years ago, it was really low, but it was still upward sloping. What we've had the last 3 years is when inflation spiked in 2021, 2022, in order to combat inflation, the Federal Reserve had to raise interest rates. And when we say the Federal Reserve is raising rates, the Federal Reserve only controls the overnight rate. So the very left-hand side of this is the only thing the Federal Reserve actually controls. The rest of the yield curve is actually controlled by the free market. Typically, it's upward sloping, but we had this weird environment the last 3 years where the Federal Reserve raised short-term rates to combat inflation, but the market viewed it as they weren't going to hold it high for very long. So the rest of the yield curve actually, it went up, but it didn't go up as much as what the Federal Reserve raised on the way over here. So you had this weird shape of the yield curve where cash equivalents, money market funds, any short-term investment was actually at a higher rate than, say, a 3-year or a 5-year or a 10-year bond. That's not normal, but that's what's been happening in the last 3 years. So being parked in cash or money market was actually the easy thing to do and the smart thing to do the last 3 years. But we're entering a period now where the Federal Reserve has been lowering interest rates. So where we were a year ago was short-term rates or cash equivalents were up here. Over the course of the year, now they've lowered to around 4% on a Fed funds rate. It's between 3.75 and 4%. What's interesting is you'll see here, the left-hand side has lowered, but if you look at the rest of the yield curve, it's basically stayed about the same. So what the Federal Reserve is doing is really only impacting the short end of the yield curve, which is another reason why we get asked, why aren't mortgage rates going down more? On a side note, mortgage rates are tied more to like a 10-year interest rate than they are what the Federal Reserve actually does. But what do we see going forward? So the question is the Fed going to continue lowering, their Fed funds rate here or not? And that's what everyone's trying to figure out at the moment. So when we look at economic data, what is the Federal Reserve looking at? The Federal Reserve actually only has 2 things it's supposed to focus on. They're supposed to focus on inflation, so keeping inflation in control, and they're supposed to focus on keeping full employment. And right now, they're in an interesting spot that these 2 dual mandates, as they call them, are actually would cause them to do different things. So inflation has been coming down. If you remember 3 years ago, inflation spiked at about 9% year over year. And then in 2022, 2023, it started coming down. The Federal Reserve started raising interest rates to bring inflation down. So when inflation is high, the Federal Reserve wants to raise interest rates. Well, it's come down quite a bit, but it's kind of stalled out at about 3% is kind of where we've been hovering now for the last couple of years on year over year inflation. The Federal Reserve's target is 2%. So they've got it down quite a bit from 9% down to 3%, but now they haven't been able to get it down from 3% close to their 2% target. So inflation would actually lead the Federal Reserve to say, we don't want to cut interest rates anymore. We probably want to hold steady. However, on the flip side, employment is showing signs of distress. So we're not adding as many jobs anymore to the economy or the employment picture, as well as unemployment is starting to pick up. It's kind of hard to see on this chart here, but unemployment now is around 4.4, 4.5%, which is the highest it's been in 4 years. A few years ago, it was around 3.5%. So we're still at relatively low levels of unemployment, which is this brighter blue line here, but it has been increasing. And this is what the Fed is looking at, is unemployment is picking up. So if unemployment is picking up and the employment picture is looking like there's more cracks in it, then the Federal Reserve wants to lower rates. So that's why they're in a tough spot, is inflation is telling them don't lower anymore, but employment is telling them to lower. And that's where we're seeing a lot of disagreements on the Federal Reserve on what they should do, because those two data points are telling them different things. It's also interesting if you look at the employment picture, when we talk about, jobs being added to the US economy, this gets a little fuzzy here. Hopefully when we send it out, you can make it bigger so you can see it. But these are how many jobs are being added to the US every month. And you can see here, the last year or so, we've been adding very few jobs to the US economy. However, there's some disagreement among economists as well at how much should we be adding to the economy anymore, because what's really interesting is our population isn't growing anymore either. If you look at this chart on the right, the red is net immigration. The blue would be births minus deaths. So are we growing, by adding more people, by having more births than deaths, and are we bringing people in from other countries? And as you can see here, it's fallen off a cliff here in 2025. We're not adding anyone new to the country via immigration, but we're also not having more babies than we are having people pass away. So we're not actually adding people to the employment. So do we need to be adding the same number of jobs we were in the past if we're actually not growing as a population? So that's something that the economists are struggling with at the Federal Reserve too, when they're looking at employment data. And then again, throwing into the mix the fact that now the last 2 months, we don't have really good data to look at anymore, is throwing another wrench into everything. I know this is getting in the weeds a little bit, but when we talk about interest rates, where do we go? What's quote unquote normal? One thing we look at is what we call the real Fed funds rate, which is their stated rate minus inflation. And what you can see is a lot of people got used to the period from 2010 to 2022 when interest rates were basically zero. Interest rates at that time were below inflation. And a lot of people, started thinking, hey, we need to get back to that point. Interest rates need to go down again. But what we would say is that actually wasn't a normal period. What's more normal, was the 30 years before that, which is where interest rates are above inflation by a certain percentage. The average from 1982 to 2010 was the Fed funds interest rate was above inflation by about 2.5%. The period from 2010 to 2022 was actually abnormal, and we don't think we're going back to a period that we saw from 2010 to 2022. So what does all that mean? What it means is that most projections here assume that the Fed funds rate is still coming down, but it's probably going to settle around that 3% to 3.5%. Whether we're looking at FOMC projections, which is the Federal Reserve projections, whether we're looking at Fed funds futures via the market, whatever metric we're looking at, they kind of all settle in around that 3 to 3.5% Fed funds rate, which is, as we looked at, above what we saw here from 2010 to, really 2022. We will note, however, that when nothing ever goes according to plan either. If you look, this year is tracking the Fed funds rate, since 1993, and you'll see a lot of times when it goes down sharply because something happens that forces the Fed to lower faster. When they do lower, you look back here, this was COVID, dropped straight down. This was the financial crisis. This was the tech bubble burst. Usually something unexpected happens and the Federal Reserve has to act fast. It's usually not, planned out in advance, a quarter every few months, nice and easy, but that's kind of what's projected right now. But we always kind of have to guard against something unexpected happening where the Federal Reserve lowers, very quickly. This is from September data here. When we say FOMC economic projections, there are voting members on the Federal Reserve. We all hear about Fed Chairman Powell as he's their spokesperson, but there's actually 12 members. And what this is showing here is the 12 members on the Federal Reserve who decide interest rates also have to put in writing what their projections are. So each one of these dots represents a voting member and where they think interest rates are going here at the end of 2025, the end of 2026, and longer term. And the point of this slide here is really just to show the separation of voting members. This is, quite unusual that we're having this amount of separation between the highs and the lows. And that just goes into the fact that there's not a clear answer right now on do they hold. There's even some members who want to raise. There's other members who want, drastic cuts as well. So there's a big separation right now on those voting members on what to do with interest rates. And then you throw all that together on what the market thinks. And, right now, these are probabilities that the Federal Reserve lowers interest rates at their upcoming meetings. I know it's a little nerdy of a slide, but what we're showing here is in December, there's about a 40% chance of a rate cut now. If you had pulled this about a month and a half ago, there was over a 90% chance that we were going to have a rate cut in December. Now we're down to about a 40% chance of a rate cut in December. But what the market is kind of pricing in as probability is a rate cut. One rate cut between now and March, probably at the March meeting, another one middle of 2026, probably June, and then another one by the end of 2026. So the market is still pricing in 3 interest rate cuts between now and the end of 2026. So what does this mean to you? As we talked about, the last few years was interesting in the fact that cash interest rates or money market rates were actually higher than what you could get by going out on the yield curve any further. That dynamic is changing. The cash rates are coming down while a lot of the medium term, bond fixed income rates are holding steady. So that yield curve is normalizing a bit. So now is really the time to just start thinking about, if you do have cash built up, which bucket does it belong in? Is it your liquidity bucket, which it is? If it is, those should be liquid in, money market funds, and Rebecca will talk about that here in a moment. But it should be something liquid. But those rates float with Fed funds. So as the Fed fund rate continues to come down, those rates are going to come down as well. So that liquidity bucket, have what you need in there. But if there are dollars that are geared, more for that 1 year or longer, at this point, you probably should be thinking about, do we lock in some of these rates on different types of fixed income investments that are still safe, backed by the government, but where we can lock in a rate. So if the Fed does continue to lower, we're locked in with whatever bond we buy today or T-bill we buy. So it's just time to start thinking about what that looks like and bucketing, cash into different things. So again, cash segmentation, your operating cash, daily operating liquidity is really key for that because when you need it, you need it. So what are the proper things for that? Bank checking, savings, ICS, which Rebecca will talk about, and short-term T-bills, backed by the government. But as we look out further, you'll have your reserves and your strategic investments, which again, you're going out further on that yield curve. You're balancing now liquidity with getting the rate. But in all of these scenarios, safety is also, a big priority, but you're able to lock in rate and you have known cash flows once you start going into these reserves and strategic investments where you're going more into T-bills and government bonds. Because what is allowed, the North Dakota Century Code does allow you as a water resource board, via political subdivisions, you may invest your funds. So what does that mean? You have permitted investments, which they are all conservative. If we're looking at CDs backed by the FDIC, savings deposits backed by the FDIC, government bonds or government agencies. If you're looking at municipalities, you can do municipal securities, but they have to be highly rated. So just working with someone who, can help you figure out, all of these different bullet points, which one makes sense for you at all of the different buckets. I know that was really quick, but hopefully a good overview to start thinking about what to do with your cash. And then I think from here, Rebecca, you had a few more slides, correct? I think you're on mute, Rebecca.
Yes, I have just two more, I think just two more slides here, Nathan. So if you want to just kind of hover on this for a minute and then click to the next instead of switching over to me, that would be fine. So as Nathan was talking about, what's allowed by the Century Code to be invested, and this is kind of more of a shorthanded cheat sheet from the slide prior, but all bank deposit accounts need to be covered by FDIC insurance. That coverage goes up to $250,000 per organization. So keep that in mind. Your banks, anything that goes beyond that, your banks need to collateralize those deposits with securities up to 110%, or at least 110% of your deposits need outside of the FDIC insurance. But the other thing that you can use, and this is allowed by Century Code, is what is called a depository service. And that is going to be kind of give you the best of everything, because we know if you're tracking the collateralization that your bank is providing and you're getting receipts of the bonds or the T-bills that they are pledging as collateral, you're constantly having to monitor that as well as the fair market value of those bonds. Using a depository service account is going to provide a lot more flexibility and with a lot less tracking on your part. And obviously investments are also allowed, as Nathan talked about. Any investment needs to be in U.S. government securities or U.S. organizations receiving taxpayer funding. That's how I always think about your muni investments, or other limited qualifying investments. It's really important when you start thinking about this to have a good financial partner, your banker, your investment banker. We should all know these rules and can help provide you guidance. It's not up to you to know all of it or to know all of the details. You need to know the broad strokes and then work with a really good partner that you can trust and can provide guidance on that. And then Nathan, if you'll go to the next slide for me. Thank you. So we talked about a depository service. So what this looks like is it's a bank account. You work with your primary bank. So at Bell Bank, we use the depository service called IntraFi. That is a service that helps break your larger deposit up into smaller increments and place those smaller dollar increments at another financial institution on your behalf. So if any of you have been doing this for, if you were ever involved in this maybe 20 years ago, before IntraFi came on the scene, you would run into instances where your local bank would say, you've got $2 million. We don't have enough. We can't pledge collateral towards that, or we don't want to pledge collateral towards that. And you would be stuck in the boat of breaking your bank account up into smaller increments and placing a little bit at bank one to be under FDIC insurance, a little bit more at bank two to be under FDIC insurance there, and a little bit more at bank three, and so on and so on. And it left you with a lot of bank accounts to manage. IntraFi came in and they're doing that work for you. So when you're using an insured cash sweep account through IntraFi, you really just deal with one primary bank account at your bank. That back end disbursement is handled for you. Every dollar that's in that ICS account is automatically covered by FDIC insurance, up to $150 million worth of FDIC insurance. And it means that you don't need to do any more collateral tracking, so to speak, because it's simplified for you. So it's something that North Dakota auditors are familiar with. It's specifically mentioned in the code that this is allowed. And so I think it's important for you to start bringing that into your mix because it simplifies your day and allows you then to really segment out like this is the right fit for what you need for your short term or some of your reserve funds. And you can keep that in your bank at a really decent rate of return. And then anything that goes out longer, any cash that you don't need for 1 to 2 to 3 years, that's where you would work on the investment side, ideally with that. So, okay, that is my last slide. I guess we'll just open it up to see if there is any questions, if anybody wanted to ask or anything you want to address.
Rebecca, Sarah had a question in the chat. What password managers are people typically using? And maybe you could weigh in on what you've seen. And then if there's others on the call that have ideas, feel free to shout those out.
Yeah, I use a Norton product password manager just personally. That comes in with my antivirus. At work here, we use a service called, I believe it's our IT team picked it out. I can't recall the name of it. It's like a shortcut for me. So, but that would be something definitely, to utilize or bring in your IT support for. Just ask them what they have available because it's very possible they might have a product for you or a good recommendation that's not expensive. Does anybody else on the call use a password manager that they want to share?
Not seen anybody volunteering. Are there any other questions out there? Quiet group today.
Oh, I mean, that means we either give them too much information or not enough, I think.
Well, I really appreciate you guys taking the time to be with us today. It was really helpful information and hopefully help spark some thoughts for folks. And I know the slide just went down, but as you can see, there's contact information up there. So if you guys do have questions that you think of this afternoon or throughout the rest of the week, feel free to reach out to Rebecca or Nathan directly. And thank you for all the work that you do with water resource districts, helping provide tools for them to manage their funds and make sure that they're being good stewards of those dollars. So if there's not any other questions, I'll go ahead and wrap up the call and just to remind everybody that the recording and the slides will be available on our website. So we'll get that up as soon as we get the recording finalized. And we will not have a training next month because we have our water convention in Bismarck. So hopefully we'll see some of you out in Bismarck in December, and then we'll look to probably have our next training sometime in January. So with that, thanks everybody for being on this morning, and thank you again, Rebecca and Nathan, for being on.
Thank you so much, Danny. Thanks, everyone.